Hey, what's up, everybody? Welcome back to Investing Sucks. So, this video is going to be an experiment that I was interested in doing where I take a random portfolio of stocks that refreshes every year and I compare the performance of that portfolio to the S&P 500. And the reason why I wanted to do this is because we've all heard of these stories where you have monkeys that are picking stocks at random by throwing darts at a dartboard, and you hear that they beat the vast majority of active fund managers just by doing that. Or at least these monkeys are more likely to beat the market than your average active fund manager is. So I thought this would be a good experiment to do to try and discover if success in the stock market can really just be due to plain luck sometimes, or if there's some actual skill involved in selecting winning investments. And are you better off investing with an active manager, say if your goal is to try and outperform the market, or are you better off just randomly picking stocks on your own, right? Because obviously actively managed funds are kind of in a decline now. More people are moving to passive funds, but they still are alive and well. There still are people that believe that there is a certain boost in performance you can get by investing with an actively managed mutual fund or ETF. So that's what we're going to find out here today. Now, my personal opinion on this before I dive into the actual results is that there certainly are some people out there, whether they are traders or more long-term value-oriented investors, that have the ability to consistently beat the market. But I think that ability is extremely rare, and it does take a certain demeanor to be able to do that. And you have to be very, very disciplined with your approach, and you have to control for all the behavioral biases that we all humans have when we are investing. And the data does kind of prove this as well. For example, if I go back to this Morningstar report, I showcased this in my last video as well, and this presents some interesting data when we're looking at kind of the performance of actively managed funds versus a passive benchmark. So I'll move my face over here so you can see the results a bit better. So here we're looking at a blend. So blend means kind of a blend of growth style investing and value style investing of large US stocks, right? And they have this metric at the end here called active success rate. So the percentage of active funds that are still outperforming the passive benchmark, whether it's the S&P 500 or another passive benchmark, over certain time periods. So there's 1 year, 3 year, all the way to 20 years. And we can see after 1 year, it's basically a toss-up, right? 46.8%. When you account for fees, you're roughly looking at a 50-50 chance of beating the market. And then it goes down pretty much every year until it gets into this time period of around 10 years where it levels off a bit, right? It went down 10 years to 15 years, but then it went back up where 10% of actively managed funds were still outperforming the passive benchmark after a 20-year period. So to me, I kind of looked at this data and I thought, okay, maybe there's about somewhere between 8 to 12% of actively managed fund managers that have that special quality where they can control for the behavioral biases, and they know how to outperform the market over a long period of time. Because as we look at other types of funds as well, for example, large US stocks with a value investing focus, it's a quite a similar pattern, right? 12% still outperforming over 10 years, and then it goes down to 15 or 7.2% over 15 years, and then about 13% over 20 years. And then this is growth investing, so this is going to look a little bit different because it's a different style of investing. But then if we go to, mid-level stocks, so mid caps, again with the blend, so value and growth investing, it's a little different, but still kind of around that 10% range where here, 20 years, 10% of actively managed funds are still outperforming. So I thought this data was very interesting, but we have to look at this in the right context, right? Because if we have a higher chance of outperforming the market over, say, a 10-year time span, just by picking stocks at random, than what we're seeing in the data here, this active success rate of actively managed fund managers, then we kind of take that data and we say, okay, yes, it's still possible to beat the market by investing with an active fund manager, but maybe we're more likely to beat the market if we just invest in stocks at random and we don't pay any fees and we just kind of do it ourselves. So that's what I want to find out in this video. Okay, so now I want to actually talk about how I went about putting this back test together. So if you're just interested in seeing what the final results were, then you can skip to that part of the video. I'll put timestamps in the video so you can do that. But if you're interested in what the mechanics were behind this back test, that is what I will discuss here. So basically the back test, it's a 10-year back test, and it starts with you buying 50 random US stocks with a market cap of at least 100 million, right? And I went with only US stocks because again, we're comparing to the S&P 500, so I can't really compare a US stock market index with international stocks. It doesn't really make sense. So just US stocks, they have to have a market cap of at least 100 million, and there's 50 random ones that you buy each year. And then at the end of the year, it assumes that you sell all 50 stocks and then use the proceeds to buy a new set of 50 random stocks. And it just repeats that process every year for 10 years, right? So this is the code that does that. I'm not going to explain how all this code works, but I do want to point out these three lines here, which if you want to run this for yourself, which you can do again on my website, which is tickernomics.com. I'll leave a link in the description. It's currently a free website to use. And if you go to the public scripts feature and then you search for the name of this script, which is just called the Monkey Simulator, it'll pop up and then you can run it for yourself. But basically, if you change what's in the code here, you can change this number. If you want to do 100 random stocks instead of 50, you can do that. If you want to change the minimum market cap to say $1 billion, this number here is in millions, so this represents 100 million. So you can do that as well. And if you don't want it to be just US stocks, you can change that as well. But anyways, I'll give this script a run so you can see what one sample looks like. In the results that I'm going to show you later, I ran this many times to get, a wide range of examples, but I'll show you what one example actually looks like and how the script works. So we'll click run here, and it's going to generate two things. It generates a table which shows all the stocks you would have bought, and it generates this chart here, which basically shows how a investment of $100 would have grown over the 10 years if it was invested in the random stock portfolio versus the S&P 500. And what we can see here, this is interesting, we actually get a sample where the random stocks outperformed, right? So the S&P 500, we can see in the bottom left-hand corner here, would have grown to uh, $387 versus the random stock portfolio would have grown to just over $400 right here. So this is one example. And then if I close this, I'll show you the actual table. So this table here shows what the companies were you would have invested in. So this is the ticker symbols here. This is for the first year. And then there's the return percentage that also included the market cap. So the market cap that you would have invested into these companies at. And this is a long list because there's 50 stocks every year for 10 years. But again, this is the results here. Okay, so now let's take a look at the actual results. So I ran that script that I just showed you 25 times here, and I took note of what the ending value was, so what a $100 investment would have grown into under the S&P 500, and then also under the random stock portfolio, what the annualized return was under the random stock portfolio, and then how much it over or underperformed the S&P 500. And overall, it outperformed 7 out of the 25 times, so 28% in total. And the best result we got was this one here, where it resulted in a 20% annualized return, and your $100 investment would have turned into $618. And the worst one was just before that, which was 10.3% annualized return, which underperformed by about 4% annually. So still a pretty good result overall. But yeah, overall it was 7 out of 25 times, so 28%. And this is assuming, again, that you have a minimum of $100 million in market cap. And we can see most of the time you're going to underperform the market still. But what I was curious to see is how the results would change if instead of having a minimum of $100 million in market cap, we went up to something like 10 billion. So we're looking at more large cap stocks because there is a significantly larger amount of companies that are kind of in the 100 million to say 5 billion market cap range than there is, 100 billion plus, right? And a big driver of the S&P 500's strong results over the past 10 years was the very good performance of large cap stocks, large cap tech stocks like Amazon, Apple, Microsoft, Google, Tesla, we all know the typical names. So what if I increased it to a $10 billion minimum market cap? I would expect the results overall to be more positive because there's a higher likelihood of us investing in these larger cap stocks that had better returns over the past 10 years. And that was the case. It was now 9 out of 25 times. So I ran the test again another 25 times. 9 out of 25, so 36% of the time you would have outperformed the market, right? So overall, it seems 36% of the time you outperform, 28% here. Now let's go back to our our Morningstar report here, and I'm just going to move my face so you can see the results a bit better. Remember what we said before, over the 10-year time period, it seemed it was usually in the range of 8% to 12% of these actively managed funds were still outperforming the market over that 10-year time period, right? So for example, we have 12% here for the US large blend companies, US large value, 12%. And then a growth investing still about 11%. And we can go down the list, but what you're going to notice and what I was kind of alluding to throughout this video is you do have a higher likelihood of outperforming the market just investing in stocks at random, doing it yourself, not paying any management fees, than you do if you were to pay those high actively managed fees and try and invest with an active manager. Now, another important consideration is this doesn't account for taxes, right? This is assuming tax-free, which is still a reasonable assumption because most people have access to tax-advantaged accounts that they do a lot of their investing in. You would have to pay a little bit in transaction fees, but I think in today's day and age, those fees are very minimal. So I thought this was a very interesting finding that was worth sharing with you guys. And again, in conclusion, what we've learned is you do have a higher likelihood of outperforming the market, doing it yourself, literally just picking stocks at random, removing all behavioral biases and just randomly generating, say, 50 companies and investing in them than you do having to try and pick a good active manager and beat the market that way. So I hope you guys did find this video insightful. I hope you learned something watching this video. And again, if you're interested in running the script for yourself, you can do so on my website here, tickernomics.com. And yeah, thank you so much for listening, and I'll see you guys in the next video.